Hi everyone, Lee Pacchia here, and you are watching The Business of Law, where we talk about the challenges and the opportunities facing the legal profession. My guest today is Romesh Jayawickrama. He is the founder and CEO of BankerBay. Welcome.
Thank you very much, Lee.
So let's start with the basics. What is BankerBay?
Okay, so BankerBay is a deal origination platform. With any platform, you'll have two sides to it. So on one side of the platform, we have mature corporate seekers of capital, and the other side of the platform, we have institutional investors of capital, so private equity funds, private debt funds, etc.
How long have you been around?
It's coming up to 2 years now. Operationally, it's about 20 months. We've got offices, we're actually headquartered here in New York. We've got offices in Singapore and India as well.
So you'll probably object to both of these terms, but just trying to get a feel for how you operate. Is it more crowdsourced matchmaker or broker-dealer?
I would say neither. It's a little bit more like, it's a combination, I guess, of crowdsourcing and a Match.com, in which we profile really the seekers of capital, for example, profile who they are, the historical track record, what they're looking for, whether it's equity, the type of capital they need, the size of capital, from what types of sources. And we do similar on the buy side. So we profile the private equity companies and what they're looking for, which is a little bit more like a dating service. And then our algorithms really correlate those matches together and output a scoring system with a high correlation, low correlation, etc. result.
So take me through the process. How does it work?
So if you're a corporate, we focus mainly on the mid-market around the world. We are sector agnostic, we are global, and the intent is really that money and capital has been fungible for many years, but information, ironically, hasn't been. So we're trying to actually converge the fungibility of capital as well as information. So essentially, when you get onto the platform, if you're corporate, if you're a CFO, if you're a banker who represents a sell-side deal, you get to the platform, you register who you are, you go through all of the criteria depending on what type of company you are. If you're looking for M&A activity, if you're looking for private equity, refinancing of a private debt. You pick which bucket is most appropriate to you, and you fill in the criteria, everything from a description of the type of company, the sector, the subsector, the geography, and historical financials, as well as what you're looking for, what type of asset class, what type of equity or debt that you're looking for in the future. The mirror image of that really happens on the buy side, and that's really user-generated content that is used to match the buy with the sell side.
Are transactional attorneys using BankerBay as of yet?
Yes, actually. Interesting enough, that's actually an increasing pocket of growth for us. Obviously, particularly in the M&A world and corporate advisory worlds, there's a lot of attorney interest. So one of the big segments of our user growth is actually coming from the legal profession.
You have a really interesting view of the world. From our vantage point as people who are on the sidelines, deal flow worldwide, particularly in Asia, looks strong, but it's always good to hear what things look like from the trenches. How was 2015 in your view?
2015 is actually a little bit of we're in a crossroads. If you look at the way of the deal market, since 2009, the deal market has been actually around the world being accelerating through the years. 2014, for example, we saw some historic peaks for deal activity, particularly in private equity, in valuation terms and volume terms. To an extent, we saw a little bit of that in the first and second quarters. But what's happening is that the nature of deals is changing quite dramatically, not just in North America, but globally. In that the deal activity in terms of numbers is still maintaining a very, very high trajectory, a very strong gradient. But the nature of the deals is changing. So the first half of last year was very, very dominated by private equity and expansionary capital of all sizes. The first half, we saw a significant slowdown of private equity expansion, which was replaced by private equity companies exiting their investments, but more than being mitigated by strategic buyers buying into their exits. So a lot of M&A activity has actually been a significant accelerator of the second half.
As we approach 2016, what are some of the things that are on your radar as potential blips? Are you worried about China and market uncertainty there, for example?
Yeah, I think it would be foolish not to be worried by China, but I think it's also equally foolish not to be too surprised by what's going on in China. I think the market overall, particularly on the tradable security side, has been very reactionary, as historically markets like that tend to be. Whether you react aggressively towards a rumor or news, it's still a reaction. Mm-hmm. It's not particularly proactive. In real terms, China's been slowing down for several years, quarter on quarter in a number of different pockets. It's been slowing down. Everyone's been aware of that. What happened this time is that China sent a very strong signal to the rest of the world that they are also going to conduct some mitigating measures to try and reduce some of the impact of that slowdown, hence the devaluation. That caused a very, very sizable wave through a risk wave through equity markets around the world. That, I think, is somewhat of an overreaction. I think a deflation of the lofty valuations and the sloshing liquidity that's been built up since 2009 was very much needed. But I don't necessarily think that kind of a systemic reaction was required, because the problem isn't really necessarily systemic. So in our view, in my view and our view as a company, and this is supported by a lot of the statistics that we have on BankerBay in terms of deal flow, etc., and valuations, is that we need to see a little bit of a correction in terms of what's been going on in the market, and a correction is actually a relatively healthy thing. You can't maintain this level of liquidity and this level of growth and this level of inflation across all asset classes for too long before something has to change. The question is it a correction or is it a systemic collapse? In our view, it's much more of a correction.
And a correction doesn't necessarily mean a slowdown in deal flow, does it?
No, absolutely not. Again, it comes back to the change in nature of the deal flow. So already, for example, in valuation terms, you saw valuations across the private equity markets, again, across the world, really starting to accelerate and peak around fourth quarter 2014. In the first half of 2015, valuations have actually maintained a pretty lofty high, comparable to the second half of last year as well. But what's happening anecdotally in the third quarter, and I think this will be much more of a theme in the fourth quarter, is that these valuations are starting to pull back. Inevitably, if the rest of the world is readdressing valuation, you're seeing a deflationary environment for asset classes in the public equity markets, it's inevitably going to have a triggering effect to sustainable valuations in the private equity market and the M&A market as well. And we're starting to anecdotally see that in the fourth quarter. We expect that to be more thematic, and that we think will follow through into 2016 as well.
We live in uncertain times. Romesh, thank you for stopping by.
Thank you very much.
That's what we have for this week. If you'd like to see more of the stuff we're working on, be sure to go check us out online. You can find us at mimesislaw.com. We're also on Facebook, LinkedIn, and Twitter. I'm Lee Pacchia. Thanks for watching, and see you next week.